time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So, we had a question on Algoma Steel, ASTL on the TSX, and someone posted on one of our older Stelco videos, STLC on the TSX as well. So I thought that, it might be a good idea to compare these two similar businesses. So Stelco Holdings engages in the production and sale of steel products in Canada, the United States, and internationally. It offers flat-rolled value-added steel, including coated, pre-painted, cold-rolled, and hot-rolled sheet products, as well as pig iron and metallurgical coke. The company sells its products to customers in the construction, automotive, energy, appliance, and pipe and turbine industries. Algoma Steel, very similar. It produces and sells steel products primarily in North America. It provides flat and sheet steel products, including temper rolling, cold rolled, hot rolled, pickled, and oiled products, floor plate, and cut to length products for the automotive industry, product manufacturers, for the light manufacturing and transport industries, as well as some infrastructure. So both of these companies have come under question due to their low valuations following the rise in steel prices during 2021 and 2022, and the subsequent increase in profitability for both companies. So let me just, run down the line here and kind of compare the two. So Stelco right now trades at about $34.85 and it has a $2.2 billion market cap. Algoma trades at about $9 and has a $938 million market cap. Stelco pays a 3.5% yield, which is slightly higher than Algoma's of 2.9%, and both have a payout ratio in the most recent quarter just under 4%. So they're not paying too much out in earnings, but we would expect to see this payout increase as profitability was a little lofty here, and I'll get into that shortly. So for the most recent quarter, Stelco's revenue was up 13% year over year, while Algoma's was up 18%. And Stelco's adjusted EPS was up 14% year over year, as well as adjusted EBITDA was up 13%, whereas Algoma's earnings per share were down 47% and adjusted EBITDA was up 27%. Looking forward, both companies came out with not the best guidance, obviously because of where we've seen steel prices go. Stelco's management said that adjusted EBITDA in Q3 is expected to be materially below the Q2 level, and further weakening is expected in Q4, assuming the lower prices and shorter lead times being experienced currently fully impact results and prevail through the remainder of 2022. Essentially, this is the same for Algoma, where they provided Q2 2023 adjusted EBITDA guidance in the range of 75 to 80 million, which would be a decline of 82% year over year. So you can see that they're really chewing through these tough comparables right now. Looking at the balance sheets, both are very cashed up, with Stelco having $1.2 billion in net cash, which is about 55% of their market cap, and Algoma has $1.04 billion in cash, which is 110% of their market cap. Looking for the uses for the cash, Stelco recently commenced a substantial issuer bid to purchase up to 30 million shares outstanding at $35 per share for an aggregate purchase amount of about 1.05 billion, and they're looking at retiring about 47% of their shares. And they also recently increased their quarterly dividend. And Algoma actually just recently did the same thing as well with their cash. They had a substantial issuer bid where it purchased for cancellation 41 million common shares at a purchase price of $9.75 for an aggregate purchase price of approximately 400 million. So this 400 million that they used to buy back shares was after the last quarter was reported. So we should remove that 400 million from that net cash balance that I quoted earlier. And just looking at the valuations, they are very low here, but this is looking to change, like management's guidance being very lower going forward. So right now they have a trailing PE of 1.5 times for Stelco, and a trailing PE of 1.1 times for Algoma. So both businesses are heavily reliant on the price of steel, which is why each management team is guiding toward weaker quarterly results over the next few quarters. But it is great to see that both companies are aggressively retiring shares while they are cashed up from a period of increased profitability. My short and sweet conclusion is that if one was looking to purchase either stock in the near term, I think that patience may pay off as both companies need to lap through their difficult comparable results from steel trading in the $1,800 range, as ultimately the trailing numbers will look better than the forward numbers. So once these numbers are lapped and both companies push for growth into 2023 and 2024, I think it would be good to revisit each story to really get a gauge on the growth going forward and what their valuations do actually look like. But one last thing that I will say, it is very interesting to see how EPS or earnings per share will be affected for both of these businesses with all of the share backs. But yeah, just in the near term, I would be cautious. I think that both are good businesses, but yeah, just very reliant on the price of steel.